a good, smart financial decision because yes, if you're paying your principal in addition to your mortgage, sure, you're gonna eventually chip away at the interest you're paying and that balance. But if you're thinking about that already, look at what the all-in-one loan can do for you. If you're in the position financially to do that already today, why wouldn't you want to leverage a way to accomplish that while also keeping access to that money that you've earned and that you're putting into place? The stats are 4% of mortgage holders, only 4% of mortgage holders in the entire country make extra principal payments. And the question is why? So the client, married couple, both with great jobs, good long history of employment, very little debt, but they've got their average household expenses, childcare, all of that. They've owned their home for many years, owe very little on it. So they are now going to be buying a new home. They don't want to buy their home contingent, and they're in a fortunate position to be able to acquire a new property while waiting to sell their existing home. Once they sell their existing home, they have a decision to make about what do we do with that cash proceeds. In their case, they wanted to continue to pay down their debt. And so the first conversation we have is, okay, yeah, you can do a 30-year fixed mortgage, and we can do what's called a recast. It's a servicing function that allows you to pay down your principal with a large principal payment. It's a one-time fee, and it will re-amortize your loan to reflect the new payment with your existing terms, to basically show, here's your balance, $800,000, here's your balance, $600,000, here's your new payment. And that's great. I mean, it means you're gonna have a lower mortgage, lower payment each month. My proposal to them was, well, what if you can keep access to that money if you need to for your future, whether it be for your college, your kids' college, a new car, whatever your future expenses might be. So you still have access to that money while still achieving the goal of lowering your cost of your mortgage, reducing your balance, all of that. So we went through the exercise of running an all-in-one scenario for them. And in this case, not only are they going to be able to achieve the same goal of lowering their overall cost for their mortgage and retain access to it, but they're going to accelerate paying off their mortgage less than 10 years. So they're going to pay off their entire mortgage in less than 10 years by doing nothing different in their current financial situation other than running through the modeling of why this all-in-one works based off of your cash flow, based off of your financial profile, and having it apply in a way that is more efficient and more cost-effective than a traditional 30-year fixed mortgage. Our company built a very intuitive online modeling system and tool that allows us to sit down with every one of our clients and not just create a bunch of hypotheticals, but we're going to use actual real data that you provide us from your financial picture to represent what the results would be using our loan program compared to a 30-year fixed. And so we wanted to develop this to ensure that every client is different. So we want to be representative of your specific financial profile, but also to give you a roadmap to be able to showcase how this loan works, the mechanics behind it, the math behind it, but also to recognize that your financial picture is not linear. It's not going to be a straight line. There's going to be moments where you need access to money for unexpected events or future investments. So we built and developed our modeling system to showcase how the loan works based off of your current situation today, but giving you the flexibility to be able to make adjustments as you need, because in life, it's going to happen. So we want you to know that you have control over this, you have flexibility, and you don't have to stay on this path forever, but it's still going to present to you a better means to finance a property most of the time, given your situation, if you follow this, the plan that we present. And so what we'll do is we will run through our calculate savings, and this is our interactive comparison simulator. And again, this is all open to the public, but I always encourage our clients to come to me first and say, let's talk about how this works before you start diving into the calculator, because there are some nuances to it that we want to make sure we cover and that we understand what data we're entering and why. So it's always recommended that we have a chance to first talk, see if your situation applies, because while we believe this loan is the best loan out there, it's designed for not everybody. It's designed for people that have good financial discipline, that have good credit profiles. So there are some requirements that we have to maintain. So everybody should know about the loan, but it's not for everyone. And that's one thing we always try to emphasize it. And it often comes up when people ask us, well, why doesn't everybody do this loan? And because not everyone's in the same situation as you are. So it's a very personalized, very customized product that we do like to showcase and educate our clients about, but it may not be the right fit for you. But this simulator is going to help us determine how it's going to work and will it work for you, and they really show the power behind how it works. And as we've talked about in the past, the basic premise of the loan is going to be an interactive sweep banking account that we create that is customized and very specialized to this product. And the reason being is that unlike your traditional checking account today, that your money just gets deposited, waits to be used, sits there idle, not really being very effective with where it's sitting until you need the money for your bills or your expenses. Our all-in-one checking account is designed to have a sweep function where every deposit you make is going to be moved to pay down the principal of the largest debt you have in your life. And so that's really the mechanics of why this loan works very different than anything else. It's not that people can't move money to a place that's more efficient for them or is going to benefit them better. It's not everything's automated. And so when we look at the all-in-one account, you're going to have this automated feature that's going to move your money immediately. And when the money is moved into your checking account, every night it gets deposited and pays your principal. That mathematically is going to then reduce your balance you owe. And the other feature of this loan and why it's so incredibly powerful and why it's also very different than most traditional financing instruments out there, including 30-year fixed mortgages, including credit cards for that matter, is that your interest is accrued on a daily balance, not average daily balance. And why that's really important for this product is because the longer your balance stays low throughout the course of the month, the less interest you're going to be charged. And as we know with our expense profile, typically your expenses aren't always due daily or even weekly. Most of our expenses are going to be due monthly. And so by just the timing of when expenses are due, you're going to benefit from an interest cost as your deposits start to work for you, keeping your balance low, keeping that balance low throughout the course of the month. It allows us to recognize a lower cost of interest. And then when your expenses are due, it simply gets swept back into your account and use it instantaneously 24/7 to be used to pay for whatever bills you'd like or for ATM withdrawals, whatever you need. So that's really the core concept of why this works, is the movement of money, where it sits, how long it sits, and having access to it 24/7, unlike other types of accounts out there, including home equities for that matter. So as we go through the mechanics of where the money comes and goes, we then use our interactive simulator to showcase, okay, let's take a look at what a standard purchase of a home would look like today, comparing a 30-year fixed to an all-in-one. And we always want to emphasize to a client saying, look, this is going to represent a comparison, but this loan is very different than a 30-year fixed. We're going to do our best to give you a side-by-side comparison of what this achieves versus a 30-year fixed, but recognize that in and of itself, it is a different financial instrument. So it's sort of like comparing apples to a baseball, where they're both round, they both fit in your hands, you can both throw them, but you might want to eat an apple and you might want to throw a baseball. So they're going to look and feel similar in terms of what they're used for, but to get an apples to apples comparison on this is a little bit different. So we want to be able to showcase how it can look while also remembering that there is some differences to how this product works from a 30-year fixed. But in that case, we are going to look at, okay, let's say we're going to do an $800,000 purchase, 20% down. And what we'll look at is we're going to compare a 30-year fixed rate today. That's going to be the baseline to say, here's what your principal and interest payment is going to look like. Just the math behind what a principal and interest payment is going to be on a $640,000 loan balance under this interest rate environment. Then we're going to look at our clients' deposits, because like we talked about earlier, your deposit activity is going to be moved to pay your principal overnight. So we're not asking you to change your withholdings or your 401k or even your retirement planning. We want to showcase and represent what your deposit activity, your cash flow coming into your account will do as it relates to the interest computation of when your payments are due. So again, we're going to look at deposits coming in and then your expenses going out. So what we'll say is, let's just say we're using a dual income family. They've got some income coming in from both household members. And then we also look at one-time deposits. So the other question we say to folks is, where do you keep your money today? Do you have short-term savings where it's emergency funds, for example? And you got 20,000, 30,000 just sitting there just in case for purposes of short-term use. Well, in today's environment, most savings accounts are collecting very little interest, if anything, nominal in terms of what you're actually getting from it. And then at the end of the year, what do you get? You get taxed on it. You're going to get a taxed interest income on that. So we're saying, let's hypothetically look at it and consider moving that money into the all-in-one, where you still have access to it. You're still going to be able to use it if you need to for emergencies, but it's going to lower the cost of the largest debt that you owe. So in this case, let's just say $25,000. Then we'll look at other repeating deposits. We'll say, do you have bonus income? Do you have any type of variable income? Maybe you have rent from a property, or maybe you're going to propose a new type of job. So we'll also throw in and say, let's say they've got an annual bonus that they bring into their household. And again, so what we're trying to represent here is, what does your deposit activity look like? What's your cash flow looking like for your home? Because this is going to then directly relate to the timing of how these deposits come in, and then how frequent they are and the amount. Next, we're going to look at your expense profile. So when we get to the expense profile, we have a couple different options you'll see here in our system that allow us to itemize it or use just a percentage. When we look at the itemization, I always encourage folks to think about, do you have a budget? Do you actually know where your income and your expenses are flowing each month? And if you don't, this is a good opportunity to have that conversation, because we in the mortgage community, our job, of course, is to qualify you for a mortgage, help you, get into a home. Here's your mortgage, here's your payment, here's your down payment. But I've always taken the approach of saying, mortgage is just one piece of your financial picture. This product and this simulation allows us to dive deeper into your overall financial picture. And so if it's not now, when would be a good time for you to look at and say, what does your spending look like each month? And so we have the opportunity to dive into this a little bit. Some people come prepared and say, yeah, I know exactly where my money's coming and going, whether it be food, gas, utilities, all of that. And this will give us a good, real representation of their financial picture. If not, we can always just say, let's take a look at what is your average cash flow? Like, what's left over? What are you kind of stashing away for your extra savings, for your emergency funds or whatnot? And what can we do with that money that's going to be more powerful, more efficient for your needs than having it sitting around waiting to be used? So again, it's all about the cash flow. What we are going to also represent is tax and insurance. So this loan does not have an escrow account. I can talk more about that with you or your clients, but ultimately, taxes and insurance are escrowed. It's a convenience factor, but it really is fronting the cost of a future expense. So really, from a financial standpoint, your money can be put to use better by paying your taxes and insurance separately from your mortgage. But 90% of the mortgages, if not more, are escrowed. In our case, for this loan, because of the way what we're trying to achieve, we are going to have escrows pay outside of closing. Outside of your mortgage, I should say. So that way, we're going to give you the control of that, so that your cash is being put to use more effectively over the course of the year. And then when taxes are due in the year, you can write a check right from your account or wire money, whatever you need to. But from a representation standpoint of our results, we want to make sure we're showing what that cost would be in relation to your simulation. So that's a note that I always want to make sure we talk about. So people say, well, what are these numbers based on? Well, it's based off of your current mortgage payment. If you were to do a 30-year fix at 6.5%, if you have taxes and insurance of almost a little over $1,000 a month, which is pretty high, then we're going to look at, okay, what is what is your average monthly expense? And what are we having left over? For this loan program, we typically say, if you can utilize about 20% of your overall net deposits that you're putting away into an account. In other words, you've got some leftover money. This is a program that you want to reinvest into this largest debt you owe to help pay it off, lower your cost of interest, give you freedom and flexibility, and help you build wealth faster. We're going to say, what if we could invest this into the loan? What if we could imagine paying off your loan faster by using just your discretionary savings that you've got? So anything that is about 20% or more, we say, you know what, let's take a look at that. And now when we run the simulations, we're going to say, wow, all of a sudden, compared to a 30-year fixed loan, you're paying off this mortgage in less than 14 years, half the time that you would pay by being very conservative with our information, with our data, and really saying to yourself, how much interest are you also saving on this? So that is a conservative, and we can go back and make some adjustments. So in this case, we're just using $2,300. Let's say these folks are saying, you know what, we don't have a lot of expenses. Let's say we're at about 25%, so a little less than $3,000, which sounds like a lot to folks. But remember, this is all of your expenses coming out in it outside of your mortgage and housing payment, which 42% of household debt is your mortgage. So everything else we're representing in our expense profile for the month is outside of your housing payment. So as we go back and say, let's increase this a little bit, see if we can be a little bit more aggressive with that. Now you're paying this mortgage off in less than 12 years. So that's what we try to showcase to folks, to say, you know, can you imagine paying your house off in 10 or 11 years? Most people can't even think about that. Most people don't even think they're going to be in their house 10 years. Well, if you're not going to be in your house in 10 years or over 10 years, how much interest have you paid in 10 years compared to the interest you're going to pay with the all-in-one? Well, here's another simple chart to look at. For the average 30-year fixed loan, it's a simple repayment plan. You have a defined payment schedule that is set in stone. And the majority of people in this country will just make their mortgage payments as is every single month until they sell the house, refinance, or whatever. And in the first 15 years, you'll see the yellow lines is interest. So for the average household, the majority of your payment every month is going to interest. It's almost criminal how much interest the banks will charge for a mortgage. Now, again, it's a good product. It helps people get into homes, creates affordability, all of that. But the actual structure of a 30-year fix is literally you are spreading the largest debt you have in your life over the largest amount of time possible. And so if the average homeowner is in their house 5 to 7 years, or in the mortgage 5 to 7 years, what have they done for the first 5 or 7 years? They've paid predominantly interest. So by year 10, for every $100 you spent, only $23 has been spent to principal. This is just the math. This is the average mortgage based off of the repayment structure. And so when we look at this scenario of the all-in-one and what the mechanics are all about, we're paying your principal first. Of course, there's interest accrued, but as you start to reduce your principal early into your loan, there's a staggering effect to where your principal and then your interest is going to be accelerated down. And so when you look at the actual payoff table, and again, this is the 30-year fixed loan. This is our loan using the data you provided us. After 5 years, you'd have paid $218,000, almost $219,000 in principal. On a 30-year fix at 6.5%, you'd have paid less than $41,000 in principal. This right here is the math. And so if you don't plan on being in your house for 30 years or in the mortgage for 30 years, this loan is by far not the most financially sound product. Sure, it got you in the house. Sure, it gives you a low payment. But in terms of you making a dent and actually owning that house and actually creating wealth and freedom of debt, this is not the route to go. And so the other question is, well, yeah, what happens if I sell my house? Well, that just means that all that principal you paid into, all that money you're investing in this largest debt, you sell your house, now all of a sudden your cash proceeds are going to be substantially higher. So you're getting that money back. It's yours. And that's the premise of this loan. That's what makes this so different. And for a lot of people, a little bit hard to conceptualize is because when you put extra principal payments into a 30-year fix today, that's a great strategy. Nothing wrong with that. If you've got the means to do so, if you've got the cash and the excess income to say, you know what, I'm going to throw an extra principal payment in there each month, start chipping away at my principal. Great. The question is, why aren't more people doing that today? The stats are 4% of mortgage holders, only 4% of mortgage holders in the entire country make extra principal payments. And the question is why? Well, the answer is because when that money is applied to your principal, it's gone. Interest is still going to be there at the end of the loan. So you're not only are you letting go of your extra cash flow to use for emergency purposes, for future investments, whatever you want to use it for, you're also not recognizing that benefit until years down the road. So there's no immediate benefit to doing, or incentive for that matter, of putting your extra principal payments into your mortgage today. It's a good, smart financial decision because yes, if you're paying your principal in addition to your mortgage, sure, you're going to eventually chip away at the interest you're paying and that balance. But if you're thinking about that already, look at what the all-in-one loan can do for you. If you're in the position financially to do that already today, why wouldn't you want to leverage a way to accomplish that while also keeping access to that money that you've earned and that you're putting into place? So that's the problem we're solving for. That's the solution that we offer for this product. And that's the reason why I believe this is the best loan program in existence. And when people ask, well, why am I only hearing about this now? Well, because CMG, we're the proprietaries of this loan. We created this loan and built it and engineered it from scratch over 20 years ago. And unless you're talking to somebody at CMG or talking to myself, you're probably never heard of it because there's no other lender out there incentivized to show you this program or to offer it because they're not able to sell it. And that's just a simple reality. If you walk into a store and you're going to buy Nikes, you're not going to go to an Adidas store and ask for Nikes. So because we sell the product, because we built it, we've engineered it, we service this, we're in a unique position to offer the most unique and innovative loan program in the country. And it solves for so many problems that exist today when it comes to financing a home. And so that's why I get very excited about sharing this with people, because it's an educational opportunity. It's a way to create freedom, create flexibility, give people access to building wealth and real estate like nothing else out there. The downside that I think, if there was some sort of critique of the loan, is there is a variable rate component to it. So majority of people are a little apprehensive and think there's a risk associated with lower interest rates or variable interest rates. And my response to that is, what we're showing you and the data that we're showing you is based off of what the interest rate would look like if it moved up or down. So we are representing in our modeling system the assumption that rates are variable. We are representing in our modeling system hypotheticals that could be very conservative. We can make it even more conservative if there is a concern of risk. So the only real downside I see, other than the fact that you've got to be in a financial position to have this loan work for you, like we talked about, you've got to have some cash flow, you've got to have discipline, you can't be racking up all of your credit card debt and then thinking this is just another revolving account for you to maximize. This is designed to reduce your debt, to accelerate paying things off, and it could be very powerful. But in terms of some of the criticism is that people think, one, like we talked about a minute ago, what if I just make extra principal payments to my mortgage today? Great, you can do that, but that money is gone. And again, so you have to decide how you want to apply your extra cash. And in the majority of the time, people would say, you know, I'll put that money in the bank or I'll go invest it somewhere else or whatnot. They're not just going to think I'm going to put my extra $2,000 into my principal each month because that money isn't accessible again. So and then the variable rate component, what we say is, in this scenario, for example, we just talked about, we also provide a comparison breakdown of a few different areas that I think are really, really important to show. Like we talked about, over 5 or 6 years how much principal you're actually paying down. So that way you're creating equity, you have access to that money. If you sell your house, you're gonna get a larger payoff. So, and when you look at the comparison loan over 30 years, your average principal reduced monthly is, 17, almost $1,800. Whereas your principal reduced every month is averaging, $4,600 more. And of course, yeah, that's extra cash, but that's going into your largest asset, paying down your largest debt. So it's an effective use of that extra money. Then when we look at what is interest rate, how do you compare a variable rate to a fixed rate? It's hard. You really would have to do some quantitative math to figure out the actual rate. Well, we did that. We have actually created a way to look at and say, if you followed this path for the next 11.4 years in this scenario, what we're showing is this is our comparison loan effective APR. So in a comparison scenario, if everything remained the same, the cost of the interest over the life of your all-in-one loan, comparatively to a 30-year fixed interest rate cost of interest, you would have to have a 3.049 30-year fixed rate. So again, you would need to have an interest rate around 3% for a 30-year fixed for the interest that you're paying on a 30-year fixed loan to be comparable to what you're paying on the all-in-one. That right there is really the best way to showcase the interest rate comparative to this loan program that is variable, that has some movement to it, has flexibility. That's the cost of the interest, your comparative effective interest rate. So when people come to us and say, well, when are rates gonna be at 3% again? Well, I can show you a way. If you followed this plan and you wanted to be more disciplined with how you approach your extra cash, this is a way to lower your cost of interest dramatically over anything else out there in the home financing industry. So a question that comes up is, when can you pay this off? Or, is there a timeline that this product works more favorably than other financing means? And the first question is, you can pay this off whenever you want. That's the beauty of this. So you get flexibility and control of paying this as fast as you'd like, or to say, hey, you know what, we're taking time off and going on a vacation. We're taking a sabbatical, or maybe there's a job interruption. So you get to push the pedal to the metal as fast as you'd like to pay this off, knowing that you can always access that money you've put in, while at the same time, you get the freedom and the flexibility to basically be your own bank to say, you know what, I'm not in a position to make my extra deposit this month, so we're gonna skip it, or we're gonna let this ride for 6 months. And the way this product works is once you've developed your credit line through your deposit activity, again, there's a difference between payment and deposits. This loan, you are having interest accrued each month based off of your balance. So again, it's not as if there's no interest associated with this loan. It is, it's a loan. It's part of the overall features. But your credit line is going to continue to build. And the way in which the interest is paid is after the 21st day of the month, there's a draw function that takes that interest that you accrued from the previous calendar period, and just comes out of your equity. So it's automated. In other words, you don't have to manually write a check for your mortgage with our product. And that's sort of a kind of a crazy concept. Even when I have this loan myself personally, and I remember after I closed a couple months into it, I go, how do I make a payment on this? But you don't, you make deposits. And so you get the flexibility of making your deposits as fast and as frequent as you like. Of course, it's gonna benefit you. And then when your interest is due, it simply gets swept from your available credit line. And so from a risk standpoint, as long as you're following your path and you just make some minor adjustments to where your money's coming and going each month, change your payroll deposit to this account, you can change your Venmo. So all those things where all your money's coming and going, you're gonna really quickly start to establish a credit line. And then when your interest is due, it just comes out of it. And so oftentimes a question is, well, what happens if, or a hypothetical of, I lost my job, or we're planning on taking a year off, whatever the case is. what's the risk here? And my response is always, well, what's the risk today with your mortgage if you lose your job? Does the bank call you up and say, hey, you know what, John, you know what, Mary, take a couple months off to get back on your feet. Don't worry about your mortgage payment. No, your mortgage payment's due that next month regardless. The way our product is designed is you get control. You get the ability to pay down, accelerate paying off this mortgage as fast as you like, and also gives you the freedom to know that if you need access to that money, it's gonna be yours. So oftentimes, this product is appealing to people because it gives them that risk aversion or risk mitigation. And it's a really powerful way to look at financing a home. Rather than a bank controlling you and your mortgage, you get to control how you want to leverage your debt. And so for me, that's one of the more exciting features of this product that other than just paying your house off faster, I think just having that ability to control and be flexible, it's very unique in our industry and in our country as far as financing a property. Most people just are used to having, here's my monthly payment. I got to cover that monthly debt every month, no matter what happens in my life. Well, some people look at that and say, well, I don't want to have to be controlled by that. So the other part of the question, as far as the maximum number of years, there really isn't, in my opinion. I think that when we talk about a traditional loan in a sense of how long do you plan on being in this home? Or interest rates are high right now, so maybe we'll be able to refinance you in the future. While you're going through those considerations of financing a property today, the math is simple, and the math is going to remain whatever the situation is that for the first 15 years, if not, the first 5 to 7, which is the average time people are in their mortgage or in a house, you're predominantly paying interest. So any way you look at it from a standpoint of how long you plan on being with the all-in-one or using it, the advantage you have is that you get control of it. At the end of paying off your all-in-one, you still have access to this credit line for over 30 years. This is a very important distinction of why this is different than anything else out there as well, where once you've paid off your mortgage, in this case, 11.4 years, you're gonna be able to have access to all of that credit line up until 30 years. After 10 years, just a quick disclaimer, we do start to stagger that credit limit because there is a finite end date for our loans, so there is a 30-year term. But unlike other credit lines, like a home equity, for example, they will shut off after 10 years. So unlike home equities, if you're thinking in the concept of a home equity, for any of those out there that have had a home equity, after 10 years, that's shut off. And then you turn into a fully amortized repayment for 20 years, which can be a big payment shock because the average consumer, they might just be paying only their interest on their home equity. Then all of a sudden, after 10 years, you still have the majority, if not all of your balance, but that payment gets adjusted to a 20-year high interest rate repayment. So unlike a home equity, this is going to give you access for over 30 years. And unlike a 30-year fixed mortgage, which is in the green here, after this pays off, that's how much balance you would still owe on this loan versus a traditional mortgage. So my recommendation is really if you're only going to be in your house 5 to 7 years, why not? Why wouldn't you want to have a position where you're going to pay off the majority of your principal, 5 years, like we talked about, after 60 months, you're going to have $200,000 paid off. You're going to be in a much more equitable position. You're going to have the ability to still receive the benefits of the investment you've made in your all-in-one for your cash flow. And instead of having a $600,000 mortgage still left, you're only going to have $421,000. So the math still makes sense any way you cut it, but it gives you complete control and flexibility. So another feature of the all-in-one that I think is one of the ways this product helps you build wealth and truly reinvest in a smarter, more efficient way with your money, with your extra cash, is you get to create a credit line for yourself to use for future investments. And so, as we talked about earlier, your financial situation is not linear. It's not set in stone. You may want to make investments. You may have large expenses. So our simulation, our interactive simulator allows us to showcase a few different hypotheticals. And let's say, for example, you want to buy another investment property and you are on the all-in-one. In this case, we're knocking down the $640,000 principal we're taking out in about 11 years. Let's say you want to take a future one-time expense. So we'll go through a lot of these hypotheticals. We'll go through some simulations on what type of scenario might come up, what kind of expense or investment, any way you want to look at it. But if you need to take money out of your all-in-one, what is that going to look like? How's that going to impact your results? So let's say in a few years, you want to take $100,000 out, okay? Pretty sizable investment. Well, let's say college tuition, new car, whatever you want to do. But in 4 years, we're going to have a large expense. Let's see what that looks like in terms of your repayment. So you're still on track to pay off your entire mortgage in less than 14 years, even by taking $100,000 out in a few years for a future investment or a future expense. So you're still going to get the exact benefit of the product, but have the access to the money to use. So instead of taking out a high interest rate car loan or student loans or whatever you might need to, or even a new mortgage, you have access to this. So a lot of people that are looking to get into real estate in the future, they want to first acquire their primary residence, get into it with a great loan program. But what do you do? How do you access future capital? Well, you're going to get more mortgages. You're going to get more loans. This is going to give you a facility to help you access the money that you're investing in efficiently, inexpensively, and a tax-friendly way, because this is tied to your primary residence. It's tied to a mortgage. So like you get today with a mortgage interest expense, you're going to get a 1098 at the end of the year. So this gives you a way to access your capital in a tax-friendly environment. The same conversation can go for taking money out of a brokerage account. You're investing into mutual funds or retirement planning. Some of these accounts will still give you access to that money if you need to, but at what cost? Typically capital gains, you're going to have taxes. It's going to take 3 to 5 days to settle that money once you sell or liquidate it. So it's not instant, it's taxed, and you're taking it out of the market. This is giving you another complementary strategy to utilize your extra cash flow to pay down the largest debt while retaining access to that money in a very tax-friendly environment. So one of the questions comes up about accessing this money for a future home purchase. So if you want to use your all-in-one to buy an investment property, great strategy. If you're going to go and qualify for a new mortgage, just like you do today, we have debt ratio requirements. You're going to look at monthly obligations. This is an open-ended credit line, so the minimum payment you owe is just the interest. So unlike a first mortgage today that you get a 30-year fix, you're going to have a principal and interest payment that we'd have to count against your debt ratios. There's actually a lower interest payment that we're going to use for our qualifying for future investment properties. In other words, if you don't have all the cash in your all-in-one to pay cash for a house and you want to take $100,000 out to put towards a down payment for a future home, you can absolutely do that. And then how we would qualify you would be, we're going to look at how that withdrawal is going to change your debt ratio. And so we will work the numbers to say, how is that going to impact your qualifying for a future home? But the advantage you still have is access to that money. You can pull it out whenever you want. And just as if you would qualify for an investment property today, you'd still have to qualify with debt ratios and your income, but your debt position is going to be a little less because it's an interest-only payment versus a principal and interest payment for your current home. So to summarize and to give a bit of a common reaction and response once we go through the simulation with people, because it is revealing. It's a bit shocking. I think people have a reaction to this. There's a few questions that often come up or reactions, and I do enjoy hearing these because it's common and it's expected. It's normal to have a reaction to a financing instrument like this that you've never heard of and wonder, is this real? How is this possible? Or why am I only hearing about this now? And for me, that means that what we've done and what we've showcased is something that actually works. It means that it's going to provide you a solution. It's going to provide you a new way to look at financing a home that you've never heard of before. And to me, that's exciting. It's rewarding to show you an opportunity to leverage a product that you've never heard of before, because if you haven't talked to a CMG loan officer, if you haven't worked with me, you probably will have never heard of this. It's not a very readily known product outside of the industry, the mortgage industry, and outside of our company. So it's normal to have the reaction of, why doesn't everybody do this, or why am I only hearing about this now? Is because if it's not readily known in the average public. And that's why I'm here. That's why I'm out here to try to promote this, to showcase what we can do for you to help you solve for the largest investment most people make, and to help manage the largest debt that most people will have in their life. And so the math is the math. The numbers are the numbers. We'll work through it together. We'll see if it's a fit for you, and if it's not, that's okay. I have every other loan program available in the industry. I just particularly find this one to be one of the most innovative and forward-thinking loan programs in existence that we developed 20 years ago. So it's not new. It's been around a long time. It's just new to a lot of people that I share it with. So I'm looking forward to the opportunity to showcase it to you, to see if it's a good fit. And you can reach out to me anytime. My website, mortgageadvisorjim.com, or give me a call on my cell, 480-734-0428. And I look forward to learning more and seeing if I can help you out.